Good to see you guys again, and welcome to Tax Tuesday. And today I'm gonna finish up the filing statuses that I started with my first video. I did the how to file single and how to file head of household. And today I'm gonna finish up, and I'm gonna talk about how to file marry jointly and marry filing separate, and finally applying as a qualifying widower. Welcome to SimpleChew. I'm your host, Hank. I've been an accountant for 10 years. I also run a resale business on the side. And if you've been following me, I thank you very much. It will help me a lot if you like the video. If you're new, welcome. Welcome to my new playlist. This is all about taxes, and I'm gonna be posting every Tuesday, and I'm gonna bring a different subject. And also, if you're new, I recommend you to subscribe. Also, hit the bell because I've been putting videos every Mondays and Fridays consistently, and now I'm gonna do this new playlist for you guys on taxes, so I want you to stay tuned. Also, I have an ebook for anyone who wants to learn investment 101. It's a free ebook on my website, www.simplechew.com. It's free for you guys. So you're married, you have a wife or a husband, and you are trying to decide how you're gonna file. So you can, if you're married, you have two choices. You can either file jointly or separate. If you're doing it jointly, it's gonna have better standard deductions if you're gonna be taking the standard deduction side. The thing with filing jointly is that both of you guys are taking the responsibility of each other's taxes and also income. So you individually also you're gonna be responsible for whatever your better half is owes or is telling the truth on their income. So it could get really complicated if you don't trust your spouse. So now we're gonna go to marry filing separate, and I think maybe I scared you guys once you came to the office and you guys didn't want to do it jointly because of the explanation I gave you guys, and now you're like, nah, I want to do it separate. That's fine. You can. The good thing is you can jump around every tax season. So this year you might want to do jointly. Next year you want to do separate. You can keep coming back and forth. It just depends on what is beneficial for you guys and how protected you guys want to be in any accountant, or even if you do it on your own. There's not going to be any problems on the IRS. I'm not saying that as a legal advice. I'm just saying by experience and as just an opinion that you're gonna be fine. So just a couple of things that I will tell you guys about filing separate that this is not gonna apply if you did it jointly. You're not gonna have the same deductibles, the same tax credits, or tax breaks. So I'm just gonna break it down for you guys, all of the things you might be potentially missing. So if you guys are deciding to do it separately, marry separately, you cannot take the child dependent credit. If you have like a babysitter or you take it to a daycare, you're not gonna be able to take that credit on your tax return. Second thing that you can take is the earned income credit. Either of you cannot take it because you guys are married and you guys are doing separately. So it's kind of a pain. And also the third one is if you adopted, you can't take the adoption fees out of the credit. So that's another thing that you have to think about. If you guys think of adopting, or you guys adopted a child, you're not going to be able to take any of the fees out of your tax return. And the fourth deduction you can't take, or tax credit, is big for some people because a lot of times the husband or the wife is the one working, and then the better half is they're in school, or they're trying to get their masters or whatever. They're just in school, or they're supporting each other for a better future. And then if they decide to do separate, they cannot take the education credit, which that's a deal breaker for a lot of couples who come to the office and decide that they want to do it jointly after that, because it could be a little chunk of money that is going to be they lose. Another thing also to think about is that the child credit tax, and also any retirement contribution savings credit, it's gonna be equivalent to the individual income that the filer is submitting. So your husband is gonna have their own, and then the wife is gonna have their own. So, and if you did it jointly, it's gonna be like a whole big. It's gonna be the whole income together from the both of them. And this time it's just separating. Also, if you had any like dividends or any capital gains, you sold any stocks or any type of investment, you can only take half of the credit of capital loss. I think for 2019 is like 1,500. If you do it separately, if it's jointly, it's 3,000. Also, the bad news is that if you are deciding to take the standard deduction, it's going to be cutting half compared if you did it jointly. Also, the other problem is if your husband or your wife is going to take the automatic deduction because they had medical expenses or whatever. The other half cannot take the standard deduction. They both will have to meet the same accounting. So moving to the qualifying widow, it's really difficult when somebody comes in with their returns and they say they're qualifying widow because their husband passed away or the wife passed away, and it's really hard to convince them because some of them are really not qualifying widow because the most important part about qualifying as a widow is that there has to be a dependent, there has to be a child involved. And the best way, if you're trying to learn your taxes or you're going through this on your own and you want to figure it out, is to think about it's more for young couples where they got married and they're young and they have a child, they have a 2-year-old, whatever, they have a toddler or a teenager, but it's someone who the couples were young and the father or the mother passed away for a terrible accident or whatever, and then it leaves the young single parent now in the hardship. So the tax, the IRS created this almost like status to help the with the burden of having a dead spouse. So to qualify, if you are 65 or older or 50 or older and your spouse or your husband or wife die, most likely you're not gonna qualify to be a qualifying widow, and it's something that could be hard to understand. So the year that your wife or husband passed away, you're gonna be able to file jointly. You can file marriage jointly. Then after that, you have 2 years. You're gonna be able to file as a qualifying widow. But to qualify for those 2 years, you have to first go through some requirements. So to qualify, the first thing is you cannot remarry by the end of the year if you want to qualify as a widow. And the second one that I think is the one that confuses a lot of people, that makes a lot of people not qualify as a widow, qualifying widow, is that they have to have a qualifying child or a stepchild. It cannot be a foster child. And this one is really difficult because you have to have someone who you're claiming as your dependent, who you can claim for your dependent for that tax year. Just a few tips for the qualifying child. The child cannot have a gross income of more than $4,200. Also, the child cannot fill a joint return with somebody else. That one is a little weird. But let's say you have an 18-year-old that got married to another 18-year-old, you cannot, and they got married, they want to file taxes, and they did do their own taxes jointly, then now he's not your qualifying child anymore. Also, if he can be claimed with somebody else, maybe he's been living with somebody else and they're not been living with you for the past 6 months plus 1 day, that could be some issues that you're not going to be able to qualify as a qualifying widow. And thank you guys for watching. Hopefully, after going through these filing statuses, you understand a little bit. Hopefully I'll break it down for you guys, and any questions, let me know. Welcome to Tax Tuesday. I'm gonna be continuing delivering some videos for you guys.